Welcome everyone to another solo 401k versus self-directed IRA webinar. My name is Natalie with Sense Financial, and we are a boutique financial firm specializing in self-directed retirement accounts with checkbook control. I am here with our speaker today, Brett Synicky. Brett is our solo 401k and self-directed IRA consultant here at Sense Financial. And he has a professional journey spanning over 18 years in real estate investing. And he's not only a seasoned professional, but also a licensed California real estate agent who is dedicated to facilitating seamless transactions for individuals in their pursuit of finding or selling their dream homes. His passion lies in empowering professionals to attain financial independence and affording them the possibility of an early retirement. He is also a great advocate for financial success and a guiding force in the realm of real estate. So, welcome, Brett. Thank you for joining us today, and I will let you take over from here.
Okay, thank you, Natalie. Can you hear me?
Yeah, sounds good.
Perfect. All right. Yes, thank you, everybody, for joining us. We are talking about solo 401k versus self-directed IRA. We're going to go through each one, IRA first and then solo second, and then we're going to kind of compare the two at the very end. A lot of what I talk about is going to actually apply to both. For example, what you can invest in, how you can invest, who you cannot invest with, and what would be a prohibited transaction are virtually the same for both of these vehicles. But yes, please put questions in the chat. Love answering questions, any and all of them. And we'll definitely leave some time for questions at the end. So let me get started. Our mission, just to share with you, is to help clients obtain control of and protect their retirement accounts. Proverbs 21:5 says, good planning and hard work lead to prosperity. And you work hard for your money. We simultaneously want to come alongside you and work hard on your behalf, should you choose us to have us help you open up a self-directed retirement account. And so just a little demonstration of conventional versus self-directed. So on the left there, you have the bus. It's on the tracks, and it can only go where the tracks go. And so that would be the example of I'll call it a conventional retirement account, for lack of a better term, where you're investing in what the custodian, Fidelity, Vanguard, Schwab, whoever, could be a 401k at work, allows you to invest in. And that's primarily stocks, bonds, and mutual funds. And then on the other side, you have the off-road vehicle. This vehicle has big tires on it, higher lifted suspension, and can definitely go on the surface streets like the bus, can go on the highways, the byways, but it can also go off-road. It can go on to dirt. It can go on to, run over maybe small bushes. It can, climb over little boulders and that sort of thing, even go through the water, and you can take it virtually, almost anywhere you want to go, with some restrictions, of course. That would be the self-directed side. In fact, I'll talk more about it, but the IRS doesn't actually tell you what you cannot invest in with a self-directed retirement account. What they tell you is what you can't invest in. Did I say that right? They tell you what you can't invest in, not what you can invest in. And there's only a couple things, which I'll share, that are not allowed. And so virtually unlimited investment options. When you self-direct, you can actually invest in what we call alternative assets. Most of our clients come to us because they want to, and they know because they have experience. Now, most of our clients are investing in asset classes they're familiar with, which we always recommend. And so it's real estate primarily, but not 100%. Could be Bitcoin, could be precious metals, tax deeds, investing in private other people's businesses that they own. You can become a private lender. Many of our clients open up their retirement account to self-direct into becoming a private lender. Could be syndications as well. Most of the time it ties back to real estate in some way, shape, or form. So we offer two products, as I mentioned, the self-directed IRA versus the solo 401k. And the reason for the pictures is the self-directed IRA with all the different diverse people is because anybody can qualify for it, okay? Probably you have to be over 18, I would imagine. but there's no requirements other than potentially that and having some money to either put in from an annual contribution standpoint or roll over from a current qualified retirement account you have. And so that's anybody. And then on the other side, you have the solo 401k. And the solo 401k is for the self-employed and their spouse. Okay, so I'll talk more about this, but just those two people primarily are who can qualify and contribute to a solo 401k and make you eligible. So we'll start out with self-directed IRA. What is it first? Well, it's a tax-deferred trust account held with an IRS approved custodian. We'll talk more about the custodian here in a second. It does allow you, as we talked about, to invest in non-traditional assets, also known as alternative assets. It's been around for a long time, 1974. And, why is it so little known? Probably because a lot of people over the years have become accustomed to getting advice from financial advisors, or they just have a W-2 job and they're contributing to their 401k and they just don't know about a self-directed IRA. I mean, that's very common. People come to us all the time and they're like, this, I just recently heard about this, but hey, it's been around since 1974. And so it's under IRC or Internal Revenue Code Section 408 if you care to read through that. And it does allow you to invest in non-traditional assets, true diversification. By the way, you can also invest in stocks, bonds, and mutual funds with your self-directed IRA. You can invest in, of course, all the alternative assets, so you can truly diversify into different asset classes. And then the investment returns are tax deferred. Okay. If it's a Roth, obviously the growth on that's the Roth is money that's put in after taxes, but the gains on that are tax free. It's great. The Roth is just an amazing product. In fact, I'm going to go off on a little tangent here. I recently heard that Peter Thiel, who started PayPal way back in the day, has over $5 billion probably, and this was something I was listening to that was a few years old, so it's probably well above that now, over $5 billion with a B in his Roth IRA. No taxes on those withdrawals. The part that's incredible about that is that if you're under 50, the annual contribution to an IRA is $7,000. Now, I don't know if he has a Roth 401k, which has higher contribution limits, or if it's a Roth IRA, which has the 7,000 annual, but either way, that is an incredible amount of money. So he must have really made some wise investment decisions. My guess is he invested in some businesses. No capital gains taxes on the sale of real estate. It's great. Leverage your funds. You can get non-recourse loans. Okay. We'll talk more about what that looks like between the IRA and the solo 401k, but just know that if you want to buy real estate, you don't have to pay cash. You can do seller financing. You can get a non-recourse loan, which essentially means that the property is the only security for the loan. So if you default, the lender can only take the property back. They will take a quick look at you just to make sure that you're not a criminal or anything crazy like that. But as far as qualifying for the loan, the property is the asset and all that qualifies. So it must cash flow. You need to put between 30 and 50% down, and you need to have some reserves left over before they will approve that loan. So there's two types of IRAs. So I mentioned the word custodian a few times. Every IRA has to have a custodian. Okay. Now, what we do is, and I'll talk about what we do in a second, but our plans have checkbook control. Okay. So these are examples of custodial IRAs, which essentially means that you have to go through the custodian to make investments. Okay. The custodian controls the account. You tell them what to do, but they write the checks. They send them the wires. They, when they deposit money, you send it directly to the custodian and they deposit the money. So you're required to go through them to make investments. So that can cause delays. You definitely don't have as much control. There's some red tape to get through. They look a little bit closer at the deals that you're doing, which, might not be a terrible thing. But many of our clients, like I said at the beginning, are investing in asset classes that they are already familiar with. So it's not like they're going off into space and investing in cryptocurrency that they've never had any experience with. Sometimes that might happen, but many times it's what they already know. So the asset evaluation is not quite as important. There are some requirements for asset evaluation annually, but that's a different conversation. And then there's extra fees usually. Sometimes they're wrapped into the whole cost, but oftentimes they're custodial fees per investment, for issuing a check, purchase and sales, transaction fees, and of course, asset-based fees in some cases. So what we do, as I mentioned, checkbook IRA. So an LLC is created. This is a special purpose LLC for the sole purpose of being owned by the IRA. Okay. You're the manager of the LLC, aka trustee. It does require IRS compliant setup and operating agreement. We provide all that. And it allows you, as I mentioned, to bypass, this LLC does, to bypass the custodian when you're making investments and transactions. So a little diagram about how this works. So you open a new account with an IRS approved custodian. So this is, you come to us and you say, hey, I want to open a self-directed IRA. These are the steps. Okay. Once we get all your info, we open a new account with you and we open a new account with an IRS approved custodian, and you start the qualified transfer from a current qualified retirement account. Could be a current IRA, could be a current 401k, 403b. You can't transfer a Roth IRA. That's the only one you can't do. And that might change here in the near future. There's some talk about some legislation that's going to change that, which would be amazing. But just know currently, as it stands, you cannot do that. And so most people, because of the low annual contribution limits, 7,000, 8,000 if you're over 50, they transfer money from one IRA into the checking account for the self-directed IRA to invest in alternative assets. Because if you're going to invest in something like real estate, especially the hard asset of real estate, like you're going to own rental properties as an example, or even do private loans, $7,000 a year, it takes a little while to add up to get to enough to invest in alternative assets. So probably 99% of the people that we open a checkbook IRA for have money that they roll into it. Actually, it's called a transfer, not a rollover, when it goes IRA to IRA. And then the LLC is created. Again, I mentioned it's special purpose, single member, and you are the manager of that. So the LLC is funded, the bank account is opened, the money's put into the bank account. The IRA buys 100% of the units. The IRA is the sole owner of that. Again, you're the manager / trustee. And then you can start to make investment decisions, make investments, real estate, trust deeds, whatever you want. And then the income and the expenses must go into and out of that bank account. This is a separate entity from you. This is not your money. You are managing this money from a fiduciary standpoint on behalf of the IRA. So you can't put your own money into this account. You can't, get a check from the sale of a property that the IRA owns and then route it to your personal account and then wire the exact same amount of money to the checking account for the IRA. That's a big no-no. In fact, that can actually disqualify the whole account and be a big headache from a tax and penalty standpoint. So just stay away from that completely. But that's a quick diagram of how that works. Some more advantages of the checkbook IRA. I think we went over that one, so I'm going to skip that. What is a solo 401k? So let's move on to that. So it is IRS subsection K, section 401. As I mentioned, it's designed for those who are self-employed, small business owners, hence the word solo, covering the owner and the spouse. And it's actually came about in 2002 as a result of what's called the EGTRA law. And many of the current benefits of the solo 401k are made possible by that. You may not be self-employed, but listen to what I have to say, because at some time in the future, you may be self-employed. And quite honestly, you could potentially start a business tomorrow. It's not that hard. So you do need the presence of legitimate self-employment activity. Okay. Not a hobby. You can Google IRS definition of hobby if you want. You just can't have a hobby. An example would be you love photography. And so you, every once in a while, maybe you spend a couple $100 on photography equipment, maybe even more. Every once in a while, you go and you take photos of family or friends. You might even do headshots for real estate agents, every now and then, but you're really not making money on it. It's just kind of for fun. You're not doing weddings every weekend, as an example. Okay, that would be the definition of a hobby. So it just can't be a hobby. But there's some examples there. I'm not going to read through them all, but just know that you can very easily become an independent contractor for, we call it the gig economy these days. That's the Uber and DoorDash and what's the other big one? Instacart, those type of companies, that qualifies you as being self-employed. And you can be a day trader, a wholesaler. Of course, any network marketing company will take anybody pretty much to become one of their affiliates. And we have nurses, property managers. And one note on the property manager, something you'll definitely want to check with a CPA on or qualified attorney before you do this. Many, many people come to us and they say, hey, I have self-employment activity. We say, okay, what's the nature of your business? And they say, well, and sometimes they have a W-2 job, sometimes they don't. They say, well, I have 7 rental properties and I manage all of them. And that's my income. Okay, great. So that's on a Schedule E, right? Yes. Okay. Well, unfortunately, that's passive income. That's not earned income. That's not self-employment income. So that would not qualify you for a solo 401k. However, what you can do is you can form your own property management company. It needs to be legitimate. Okay. And that's why I say talk to a tax attorney or a professional who knows how to set that up properly, a CPA, for example. But you can start your own property management company, and then your properties can bill you. You can bill the properties rather. The management company can for managing those properties, and there's your business. So now you can take that Schedule E income and essentially turn it into legitimate self-employment activity to qualify for a solo 401k. That's very common with people we talk to that are in that same situation. And of course, you can sell stuff on eBay or Amazon. And then the other requirement is no W-2 employees. That's the easiest way to say it, but essentially no employees 21 years or over that are working, they have to work under 500 hours a year. And so that's like 10 hours a week. Okay. If they're under 21, it's okay. But just know that if you have employees or you hire somebody, we have to have a conversation. You may have to either terminate the plan, roll it over into an IRA, for example, if that happens. So here's how it works as a diagram. So you have the plan sponsor. That's the company we were just talking about. It doesn't matter how it's set up. It can be sole proprietor, corporation, LLC, S Corp, whatever. That company is the adopting business, this plan sponsor that allows you to sponsor a solo 401k plan. A trust is created. So unlike the IRA where it has an LLC, a trust is created and you are the trustee. Okay. The trust holds the assets of the plan. As the trustee, you open up a bank account and then you can do the rollovers of any qualified account, as we mentioned. Incidentally, you can not roll over a Roth IRA, but you can roll over a Roth 401k. Primarily for 401k plans, it needs to be a former employer plan. Very rarely, it has happened, but very rarely will a current employer plan you have where you're still working there allow you to roll over their 401k into an IRA or a solo 401k, as an example. And again, just like the IRA, all the income and all the expenses must be put into and out of that same checking account. So here's some benefits. Okay. We said 7,000 if you're under 50, 8,000 if you're over 50 for the IRA. The solo 401k is literally 10 times that. Okay. $69,000 annually for the contributions. Okay. If you're over 50, you have an additional 7,500 you can put in. So that's primarily in 2 buckets. Okay. You have the employee contribution. Think about the W-2 401k. That's the same, right? For 2024, that is $23,000. That's where the additional catch-up contribution is added as well. So if you're over 50 plus 7,500 for 30,500. Now, on top of that, and the way you get to the 69 is you can contribute 25%, 20 to 25%, depending on S Corp, corporate incorporated, or sole proprietor, 20% for the former. 20% for the latter, 25% for the former, and of either your net profit, sole proprietor, or of what you paid yourself. Okay. And that's how you get to the 69. And then you can take a participant loan, or incidentally, 76,500 if you're over 50. You can also take a participant loan. So you're essentially creating a bank that will never turn you down because you're making the decision as the trustee to borrow money. So a lot of people come to us and they say, hey, I have this money in an IRA and I want to pay off some high interest debt. It could be car payment, it could be a car, it could be a credit card, whatever. But they want to take this money. Well, if you're going to pay off 10,000 of debt with your IRA, you better withdraw $20,000 because it's going to cost you almost that much in taxes and penalties. However, if you qualify for a solo 401k, you can roll that IRA into the solo 401k and you can take out what's called a participant loan. Many of our clients do this. They also use the money for what would otherwise be a prohibited transaction, which I'll spend a minute on what that is. But essentially, you can borrow up to $50,000 or 50% of the total plan assets, whichever is less. And it's paid back over the course of 5 years or 15 years. 15 is only if it's used for a personal residence. And the payments need to be made monthly or quarterly at an interest rate of prime plus 1%. So that's, I believe that's 9.5. So prime, I believe, is 8.5 right now. And so let's talk real quick about the prohibited transactions. So there's disqualified people that your plan cannot invest with, or if they have an interest in a business. And there's some nuance to this that are beyond the scope of this presentation, but just suffice it to say, these people are prohibited to be able to invest with. That's you, your spouse, your children, their spouses, and your parents. Anybody else you can invest with. Okay. So that also means they can't, all those people I mentioned, the vertical line that is, can't benefit from it. So if I used my solo 401k to buy a property in Tennessee and my daughter was going to school there, she can't go stay in that property if it's owned by the solo 401k. She can't use it. Nobody can on that list of disqualified people. Same thing with an Airbnb, whatever. The other side of that coin is you can't do work on behalf of assets that are owned by the 401k. By the way, this prohibited conversation and disqualified people applies to both the IRA and the 401k. And so as a real estate agent, I can't take my license and represent myself on a transaction where the 401k is going to be the owner. I can't do that. I can't get commission. I can't do it for free. I can't work for it. So here's the easiest way to think about it, because you might be thinking, well, I want to buy real estate and I want to manage the real estate. I don't want to pay a property manager 6, 8, 9, 10%, whatever it is per month to manage the property for me. You can still manage the property. What you can do is white collar work. You can do work behind the computer. You can hire contractors. Probably, this is kind of a gray area. Probably if you own a property locally, you could show it to potential tenants. I don't know. You might stay away from that, but I've heard attorneys say that's okay. But you could do white collar work behind the computer, hire people, again, maybe open the door for people to look at it, to consider renting it, but you can't go swing a hammer. So if your tenant calls you and says the toilet's leaking, you must call a third party arm's length plumber or handyman, whoever, to go fix that. You can't do it yourself. And if it's local, you're going to be tempted to, especially if you've been doing that on other rentals you have. Just know that you can't do that. Okay. So those are some examples of prohibited transactions and disqualified people. Hopefully that all makes sense. But listen, it's okay, because it's just like driving a car. You're not going to not drive a car because you don't like the speed limit. You might break the speed limit every now and then. And I'm not suggesting you do that with your solo 401k or IRA, by the way. It's not a fair comparison, but you're still, for the most part, you're going to follow the rules. You're not going to purposely run a red light because you're late to work or you don't want to stop. You're not going to do that. Even if there's nobody around, like, it's probably not a good idea, because if you get caught, not only is it the wrong thing to do, it can cause an accident. If you get caught, obviously the repercussions can be pretty heavy. So don't want to deal with that. So it's best to just stay within the rules. You can make a lot of money doing it and sleep well at night. And then talk about the Roth for a second. We have all of our plans come with a solo 401k comes with a Roth sub account. And so it's one 401k plan, one solo 401k plan, and you can have a Roth account as well as a pre-tax account. Okay. And by the way, I should have mentioned this. I forgot. I said this covers you and your spouse. That's true. So you and your spouse, if you both are employed for the same business, the sponsoring business of the plan, double everything I mentioned, all the contribution limits, the everything, it all doubles. Okay. The participant loan doubles potentially, depending on your balance, everything. And the Roth conversion is something that's really, really powerful too. You can do that with the IRA as well. But and let me back up a little bit, excuse me. With the IRA on the Roth, you can have a Roth self-directed IRA and a traditional or pre-tax, but they're two different plans. Okay, with the solo 401k, it's all built into one plan. You separate it by different checking accounts. And of course, if you do the Roth, it's taxable money, already taxed money you're putting in. So the question is, do I want to pay taxes on the seed or the harvest? I think it's a no-brainer that if you can afford the tax hit to put as much money in the Roth every year as you can, and then potentially even convert your pre-tax IRA to Roth. So you might say, what does that mean? Well, let's say I have $100,000 in an IRA and I want to convert that to Roth. Well, I can convert that $100,000 into a Roth, but I'm going to pay taxes on it at my tax rate, right? It's going to trickle down to my personal tax return on your 1040. So you need to understand by talking to your CPA about what that will look like, but maybe it's in a year, I'm not going to have very much money. Just had a conversation with a client about this the other day. They were not going to make much money in 2024. And so we talked through the idea of doing this. And they said, well, actually, it might be a good idea this year because, like I said, I'm not going to make very much money. So they looked at doing the Roth, and I'm not sure if they're going to go through with it yet. And they're going to consult their CPA about it. But just know that you can do that. It could be a very powerful way to get more money in your Roth. Probably something that Peter Thiel did is Roth conversions along the way. And there's no limit to the amount that you can do. It's actually really, really cool. And then the plan is cost effective. With the IRA LLC, you have the LLC fee, and it depends on where you're at, but California, that can be a little bit hefty. And with the IRA, with the solo 401k, the establishment fee is less because you don't have the LLC cost and all that. And it is easy to maintain. In fact, the only time you have to as the trustee of the solo 401k, the only time you have to submit something to the IRS is annually if your plan exceeds $250,000 of total plan assets on the last day of the year. So, and it's a 2-page document. You put basically, there's a little more to it than this, but essentially you're putting your total plan asset balance at the beginning of the year, and then the total plan asset balance at the end of the year, which you only have to use this document. It's called a 5500 EZ if you exceed that 250 or higher on December 31st at the end of the year. So that's how that works. And then I talked about this. I'm probably not going to spend any more time on this just because of time. Yeah, real estate is great in the IRA, especially, or solo 401k, especially because the Roth, all the incomes and gains are generated tax-free, which is super powerful. Non-recourse financing. Let's touch on that again. So with non-recourse financing, with the solo 401k, there's a tax for IRAs, solo 401ks called UBIT tax, UBIT, unrelated business income tax. And when you get leverage on real estate, get a loan on real estate, a mortgage, you're going to have what's called UDFI, unrelated debt finance income. Okay. And that's going to lead to UBIT, which can scale up to 37%, depending on the numbers. You have to talk to your tax professional about what it looks like. But, essentially, if I finance 50% of my property, 50% of the proceeds of the property after expenses are going to be subject to this UBIT tax. Okay. Now, you don't have that on real estate, on leveraged real estate in the solo 401k. You do in the IRA. And I'm not saying that it's a bad idea to buy real estate in your IRA with leverage. It's not. It can be depending on the numbers. But again, just understand that you will have UBIT on the IRA leveraged real estate, but not with the solo 401k. So just another advantage of the solo 401k over the IRA. And incidentally, if you want it, we do have a list of non-recourse lenders. They all have different programs on our website that you can check out. And yep, talked about that. So this is just a one screenshot of the self-directed IRA on the left there. That's more of that's the custodial one that we don't offer that one. And then you have the IRA LLC and solo 401k there. So I'll leave that up on the screen so you guys can check it out. Obviously, the thing that stands out the most is the max contribution. The built-in Roth is pretty cool. Is very cool. And then with our plans, of course, you get the checkbook control, so you can invest in as long as it takes you to write a check, which is not very long, right? You can do it's a regular checking account. So you get a debit card, you could do wire transfers, you could do online bill pay for stuff. Just make sure you don't mix the card up with your personal card and accidentally pay. Just keep everything separate. That's really important. Keep track of everything. You're essentially doing the bookkeeping for your retirement account as the manager trustee. And so that is that. And then just want to make an offer. If any of you would like, we have a free ebook that our founder, Dimitri, wrote called the IRA Makeover. And it does talk about solo 401ks and IRAs. That just seemed like an appropriate name because we're talking about taking an IRA and completely making it over and self-directing, be it solo 401k or self-directed IRA. And so you can go to that URL there on the bottom and just download that ebook for free. So that might be kind of cool to check out for you if you want more info. And then just an offer, if before we get to questions, if you do want to jump on a call, happy to. It's totally free, no pressure whatsoever. But if you want to talk through your individual situation, you can go to that URL there on the bottom, SenseFinancial.com /free. You have to put the hyphen in, consultation, and we're happy to jump on a call with you. And so with that said, any questions out there?
Yeah, we have a couple of questions here. First question is from Ron. Can a retirement 457 be rolled over?
Yeah, and usually it needs to be, a former job you had, but yeah.
Okay, next question is from Sam. If I get a loan from my solo 401k of $50,000 and pay prime interest with a payback over 5 years, and then the prime goes up, do my payments change?
No, you're paying it based on the initial loan documents that you fill out. And we have, this is a good time to talk about our client portal for a second. We have a client portal that when you become a client, you'll get access to, and you can type in keywords and search for answers on questions like exactly what you just asked. And we have an article that has been written that Dimitri wrote about taking the participant loan. And then there's a downloadable document you can use to fill out the loan document properly, and that won't change. That's kind of like it's locked in. It's kind of like getting a 30-year fixed mortgage on your home. It's not gonna fluctuate. It's just simple interest, prime plus 1%, paid back over 5 years, quarterly or monthly, depending on how you want to make the payments. But you set all that up at the beginning of the loan before you take the money out.
Another question here from Sam. If some years my solo LLC does not make profit and thus I'm not able to contribute to the solo 401k, is that a problem?
No, it's not, because the IRS expects businesses, especially small, to have up years and down years and fluctuate. So no, that's not a problem at all. In fact, I've often heard Dimitri say, if you have a real estate license and you sell one home every other year, you can still qualify for a solo 401k. So it doesn't take that much activity. Of course, the downside is you're not you're not able to contribute very much each year, right? You could do rollovers all day long or transfers, but you can't do from qualified retirement accounts, but you're not going to have a lot to contribute. And incidentally, I should cover this real quick. The employee deferral on the solo 401k, the employee contribution, 23,000 or 30,500 if you're over 50, you can contribute 100% of that money of what you pay yourself. It's not based on a percentage like the employer contribution is. And so if you have a W-2 job, and many of our clients do this, the property management example I gave earlier, where people own rentals, but it's all Schedule E and they don't qualify for a solo 401k and create the property management business, they have W-2 jobs. And so what you can do is if you don't have to live on the income from the adopting business for the solo 401k, and let's say let's use a real estate agent as an example, but the same thing applies for the property management I just gave an example for. If I have my real estate license and I'm also working for another company, and I'm living off the company I work for, the employer money, and I don't need my real estate commissions to live. I can contribute. Let's say I made $25,000. I can contribute for that year. I can contribute 23,000 of that 25 into the solo 401k. So you can contribute 100% of what you pay yourself, or the net profit of the company, well, really of what you pay yourself. And so just know that that's a very powerful thing. Now, one caveat on that is if I'm contributing to a W-2 401k, that 23,000 employee contribution is per individual. It's not per business or employer. So if I have a W-2 job and I'm contributing $10,000 there, then that would give me 13,000 more in my solo 401k. So hopefully that makes sense and answers the question.
Question from Sophie. Currently, I'm self-employed. Can I roll over my previous 401k to solo 401k?
Absolutely, Sophie. And if it's a former employer, yeah, that's not a problem at all.
Question from Ron. If I have properties in an LLC, do you have to create another?
Well, let me do my best to answer the question without more information. So I assume these properties are owned by an LLC you own, and we're not talking about an LLC tied to any sort of retirement account. Then the answer is yes, because as I mentioned, the LLC is a special purpose LLC. Its sole purpose is to be owned by the IRA so that you can be the manager of the IRA and have checkbook control. So the answer is yes, if I understand what you're asking correctly.
Okay, another question from Sam. I have a solo 401k plan and took the docs to a bank and they opened the account, but it seems like they don't earmark the account as qualified retirement account. What do I do? The underlying trust files 5500 EZ, but the bank account is not showing up as a qualified. So do I transfer to another qualified account?
Yeah, it may have been set up incorrectly. Um, I'm not sure what bank you used. If you put it in the chat, that may provide some insight. But we primarily work with a couple of banks. Titan Bank out of Texas is a national bank that we primarily work with right now, and we have another one, Solera Bank in Colorado. But just know that we have existing relationships with them and back-end management connections, and so that's why we use them, because we can kind of impact the level of service that our clients get. Also, they specialize in opening up self-directed IRAs, solo 401ks, and so it's done correctly. You can theoretically walk into your local B of A or Wells Fargo and have them open the account, but they're not going to do it correctly 99% of the time because they don't know how. They're used to opening the account in the name of a business or an individual. And so if you walk in and say, I want to open the account in the name of a solo 401k or an IRA, they're going to look at you like you have three eyes. So it could have happened because of that. I don't know. But yeah, I would definitely move it, in my opinion, to Titan Bank. And you can just Google them, Titan Bank in Texas. They'll come right up, and you can check them out. And I'm assuming you're not a current client of ours, but if you are, we need to jump on a call.
We have a question here from Carl. I rolled my traditional IRA to self-directed IRA and invested in a real estate syndication that started quarter distributions. Is it a taxable event if I withdraw this distribution from the self-directed IRA?
It is, unless you're over 70 and a half and you're going to do RMDs. But yeah, otherwise it would be taxes, penalties. Yep.
Another question from Ron. Can all the proceeds from the properties and the LLC be moved to a solo account and keep the W-2 retirement account?
Yeah, let's set the W-2 retirement account aside for a second. Um, if it's Schedule E income, it's not going to qualify for a solo 401k. So the answer is no on that. The contributions need to come either from, well, the contributions need to come from the adopting business or a qualified retirement account rollover. Hopefully that answers the question.
Okay, looks like those were all of our questions today, which brings our session to an end. Thank you, everyone, for joining us. If you are interested in speaking with Brett about your situation or learning more about how you can benefit from solo 401k or checkbook IRA, please don't hesitate to reach out. We'd love to help you with setting up a consultation with them just so you can learn more. But thank you for joining and have a great day.
And let me say one more thing real quick. I forget who it was. Somebody said they had I think it was Ron. He said or maybe maybe not, but somebody said they had kind of a messed up checking account with their solo 401k or IRA. And I said, if you're
Mhm.
a client, we need to jump on a call. I just want to mention, even if you're not a client, I'm happy to jump on a call with you, not to sell you into becoming a client with us. Like, we legitimately want to help you get your situation figured out. So please don't misunderstand that. Happy to talk to any of you, whether you have an IRA with us or somewhere else. It doesn't matter. So we're just happy to help. All right. Thank you so much, everybody.